Thanks for joining us for the next installment of Bridging the Gap. I'm Lisa Kirschenbauer, founder and president of Omega Wealth Management in Arlington, Virginia. And joining me, as always, is Director of Investments and Lead Advisor for Omega Wealth Management. How are you doing, Jared?
I'm good. How are you?
Doing well. Great to be back recording these sessions. I think we've got a good set of topics today. So as the title indicates, we've launched our show, Bridging the Gap, to bring you different perspectives on money, the markets, and life. Whether it's the lens of gender, generation, or political orientation, we hope to inform, educate, and entertain you. Today, we've got some thoughts and ideas to share with you with accompanying links to articles in 3 different areas. The first one is the recent announcement by the Federal Reserve on some really important policy changes as far as their dual mandates. I'm going to tee that one up. And then Jared's going to tee up 2 other ones, saving capitalism, which I think will be really interesting, and the fact that millennials appear to be carrying the housing market. I don't know if we want to call it boom, but the boom that's out there. So we're going to talk about all those. And as always in the future, we're going to be providing weekly updates and ideas to give you something to ponder about and connect with us on the various social media platforms. We'll talk more about that at the end. But let's dive into it and talk a little bit about the recent change we had in the Federal Reserve's policy as far as their dual mandates. So first of all, just to explain that a little bit, they have had, and these mandates were set by Congress, they had 2 mandates to try to keep the unemployment as low as possible and to keep inflation below 2%, or right around 2%, actually, I think is the accurate way to describe it. As many people know, they've had a really hard time over the last 10 or 12 years of meeting that 2% inflation mandate. We've been below that for quite a bit of time. And then obviously we've got some issues around unemployment. The reason, actually, as you read into the announcement that the Fed put out, one of the things that they have been increasingly taking on is the issue of inequality in employment, and now right now in the economic downturn that we've been going through, the inequalities in who's unemployed and who has gotten their jobs back. What they had seen was that as we got to what they felt was pretty close to full employment in this country, finally, after many years after the financial crisis back in 08, 09, that people of color were much better represented in the working population. And now with this downturn, given that it's impacted the service profession, healthcare, et cetera, which are areas that tend to be more heavily women and people of color, they have decided that one way they can help with representation, which is the word I like to use, is to free themselves from having to keep inflation at 2%. And by the way, what do they do if inflation gets too hot? They raise interest rates. So what they're basically telling us is, hey, we're going to let inflation creep up a little bit more before we lower interest rates. Now, what that's going to drive is it's going to drive potentially the stock market. Because low rates supposedly drives the economy, supposedly drives what's going on with the stock market. So I'm curious, Jared, what do you think about this whole thing?
I think it's great. I think throughout this whole downturn, the Fed has really done a good job. And it pays with hindsight to see that. But we've seen, the actions they took early on as far as the lending, shoring up the debt markets with some of the ETF buying and then broader bond buying. I think that provided some confidence to the markets. And now with this, I think what they're basically saying to companies out there is, hey, we're going to keep rates low for a while. Do what you have to do to get your employment numbers back to where they were. And I think for the economy, that's a really good thing. We know that I remember reading about this thing called the Phillips curve back in economics, and it basically says that the Fed thinks if employment gets too low or too high, one way or the other, it leads to negative consequences like inflation or deflation. It's a theory, and like you said, we haven't really seen that. We had probably the lowest unemployment numbers back in February we've had in a long time, maybe even historically. That gets touted out there. I don't know about that though. So I think it's a good move for the Fed to, and it's practically speaking, it's something that we already knew. They'd already telegraphed this, that rates aren't going to move from the floor of 0% where they are right now for a long time. So practically not a big change, but policy wise, I think it's a big shift. And as you look at like over the past 100 years of the Fed history, these shifts come at times like this when we're saying, okay, things are different now. We're not in the 1980s or 1950s or whatever. We're not going to focus so much on inflation. We're going to focus on maybe something that's a little more important, employment numbers. So I think it's good.
Well, I think because we are in the investment business, I do think about what does that signal to the stock market, though. I like the mandate. I like their policy change, and the idea that we need to try to make sure that we are ferreting out inequalities in the workforce, and unemployment system. But I also think that normally sends a green flag to the stock market. If you tell the stock market and investors that we're not going to raise rates for an unknown period of time, and the stock market has already fully recovered after the downturn in February, March, where are things going? As you heard me say, I said to you personally earlier this week, I guess this means that the stock market's just going straight up now, which judging by actually the day that we're recording this, maybe not so much, but so I wonder about the ramifications for the stock market as well.
Well, I don't think it will go straight up. There will be downturns along the way. We have, a lot of uncertainty ahead of us in this fall, particularly. But I think looking forward, if you're an investor, you're not going to be able to get anything really. Definitely not above 1% with bonds right now. So if you're looking for any kind of yield, any kind of return, you're forced to look at equities. So there's a lot of talk about, maybe the old 60-40 model portfolio, so 60% in equities, 40% in bonds. Maybe you have to look at it differently, 70% in equities or 75% in equities, and look at dividend paying value stocks. We've seen value get obliterated by growth this year, so maybe those value dividend stocks become your secure dividend income sources, and you have to raise your equity positions to get a better return. I think it's to be determined. We're still early days in this. But you're right. Low interest rates historically have been a green flag for stocks. So, yeah.
So we'll see what happens.
Yeah.
All right. So, Jared, we got to talk about saving capitalism.
Yeah. So there's been a lot of talk recently about, we've seen the stock market, like you alluded to earlier, it's fully recovered. We're back at all-time highs, at least in the S&P 500. I think the Dow was a little close, didn't quite get there before today's downturn, but basically for all intents and purposes, we're back to where we were pre-COVID. And the economy certainly isn't. We talked about there being a large number of small businesses going out of business. So there's definitely a disconnect right now between the overall economy and where the stock market is. And there's been some frustration, I think, among people out there. So there's been a lot of talk also, politically about maybe capitalism isn't the best route for the future. So there's been a lot of talk in the finance world, maybe not in the broader media landscape, but in the finance media, we've seen some interesting ideas come out around how can we get more and more people buying into capitalism, buying into the stock market. And I saw one interesting proposal came from Bill Ackman, who is with Pershing Square Capital Management. He's a pretty big investor, Wall Street guy. He's proposing that every American born would receive $6,750 in a government-funded basket of index funds that could only be tapped at retirement. And he said assuming you get 8% returns over 65 years. There can be some debate about that being a high return number, but that would ultimately exceed $1 million by the time you're 65 for somebody. And it would cost the government every year around $26 billion if the current birth rate holds. So I thought that was really interesting. You know, we talk all the time about the bottom 50% of this country has zero exposure to the stock market. They don't even have 401ks. There's an absurd amount of the top 1%. I think like 80% of the stock market is owned by the top 10% or something like that. Don't quote me. That's just off the top of my head there. So I think it's a really great idea. And there was another proposal that came out from New Jersey. Similar, it would give someone $1,000 at birth, but it would only be in New Jersey bonds. So a different route, similar approach. But I think it's an interesting point and maybe a broader discussion that's been bubbling up around universal basic income. And I know you have some thoughts there, Lisa.
Yeah, you know, it's this later in the spring, you know, as we were, as the CARES Act was put into place, and you know, all these checks were going out, and then the unemployment, the $600 a week extra unemployment benefits. All I could think of is, you know, that Andrew Yang was vindicated in that whole process. And interestingly, I really think that the whole universal basic income concept is getting more attention. It's not seen quite as this, you know, fringe radical idea anymore. And then the one you're talking about of providing everyone with some sort of retirement benefit, you know, it could be really interesting if you did something like that. Because I wonder if you would also then look at Social Security and create means testing that, like, you would hand in hand put some restrictions on Social Security benefits. And so either way, you had a safety net, right? So if you had been really successful, then you'd have this, you know, market basket that had been growing for you up to retirement, whatever retirement is. Of course, there's lots of things that would have to be worked out. And, you know, maybe you'd get less from Social Security, but you had this other portfolio you would inherit at retirement. Or if for whatever reason you hadn't done very well, you'd have Social Security, and then you'd have this nest egg. And to your point, I think part of it is also the idea of having everybody feel more engaged in our economic system, and that they have that, you know, they've got some skin in the game. Yeah, they can't access it till retirement. It'd be quite interesting. I also think, you know, it'd be another factor that we would have to, as investment professionals, think about in the context of the stock market growing. Because if, you know, just like we have more and more people putting money into 401ks, that helps support over time, I think, stock market growth. This would obviously contribute, you know, not in a super giant way, but in some way. So, you know, I think this is a time of potential change where we have to, as we think about the economic inequities in our system, at least here in the United States, how can we better solve for them? And, you know, in the past, it's been sort of, you know, work hard and it'll pay off for you, but that may not be enough for everybody. And so, you know, I think we're going to hear more about all of these kinds of issues as we move forward.
Yeah. Yeah. I don't know if the work hard thing will ever go away. This is like the American dream will always, I think, exist in some way. And that's what attracts a lot of people to come here. But, you know, if you're looking at it as a country, you should want everybody to have some level of success. And I think if you can solve for, you know, at least having housing and cover some bills, maybe to relieve some of that stress, we might all be a little nicer to each other. And it's so funny about Andrew Yang predicting manufacturing being the cause of all, like, universal basic income. Who would have thought, you know, where we are right now? So it's interesting.
Yep, this will be a year that we will remember. There's no doubt about it. And, you know, I guess one of the other interesting phenomena that we've been seeing that I'd like you to talk a little bit about is that a lot of the boom is probably too big of a word, but a lot of the uptick in the housing market appears to be finally coming from millennials. There had been some concern that they had so much debt that they couldn't get mortgages or wouldn't want to take mortgages. But I think also with the Fed bringing rates down so low, it's just hard to say no to jumping in there. It's not that prices have dropped so much. I've got to believe it's interest rates are driving it. And then also people in urban areas trying to get out of urban areas to suburban areas to get away from population density because of the whole pandemic. So I'm curious, what did you find in that piece, and also what's your thinking on it?
Yeah, so basically millennials are ranging from age 25 all the way up till late 30s, I think, so mid 20s to late 30s. A lot of people thought that they wouldn't ever get into the housing market because most of them had started their careers right as the great financial crisis was happening. That put them back. We're a really well-educated group, so a lot of us went to college and then have student loan debt. That puts us behind the 8 ball as far as saving for a house. So there's a lot of speculation out there that, we would never be homeowners. We would perpetually rent. That's proving not necessarily to be the case. I'm sure there are people that will perpetually rent, but I think as you naturally get into your 30s, you start to look for a place to settle down and buy a home, and we're really seeing that. So the largest number of millennials born came in the year 1990. That puts them at 30 this year. So it's interesting how that's lining up. And then, like you said, there's a lot of factors. If you want to sound really smart about COVID, just say it accelerated trends already in place. You'll sound like a genius if you say that, I think, but it's a little true. It definitely has, I think, pushed, with interest rates being all-time lows, it's pushed a bunch of people into buying houses. Housing prices haven't really budged, but they're not going up for the first time in a long time, which might be viewed as the positive if you're looking to get into the housing market. I know in this area I've been following a little bit. I think it might be a couple of years away, but I've been starting to follow it. There are some deals to be had out there if you look. So I think it's a good sign. And 50% of new mortgages are coming from millennials. So I think it's an encouraging sign. And maybe it's not a boom, but it has been one of the only bright spots in this economy this year. It hasn't really been impacted as much by coronavirus as other sectors.
Well, and to your point, there's a number of factors I think that are playing and weighing in here, of people leaving urban areas, lower interest rates, maybe, millennials just getting to the point in their lives where, even if it's behind when boomers bought their first house, that they're just at the point where they're ready, they're, want to make a change. It'll be interesting to see whether housing prices continue rising, and also being so competitive. Certainly in suburban areas, that's a huge deal right now. But you gotta believe that there's going to be some softening. I don't know. We'll see what happens.
Yeah, I think the storyline is that inventory remains pretty low, and that can be attributed to maybe the baby boomers and silent generations staying in their houses a little longer than previous generations. There's not as much buying opportunity out there. So it's definitely something to pay attention to as far as housing prices.
Yeah, I actually, you just made a really good point. I think that we may see baby boomers and silent generation deciding not to go to long-term care facilities, assisted living, nursing homes, if they can help it, because of the pandemic side of it, which then has an impact on inventory for the millennials. So, so many unintended consequences and impacts to be unpacked as we get farther away from, the immediacy of the current pandemic and the economic issues that are out there. So I think that's definitely a stay tuned one.
Absolutely. Yep.
Awesome. I think that about does it for today. Really appreciate you joining us. As always, we're going to be looking for new topics to discuss. We welcome your ideas. Feel free to subscribe to our YouTube channel, to connect with us on Facebook and LinkedIn, our Omega Wealth Management pages. We really appreciate you tuning in, and we look forward to continuing the conversation. Be well.
See you guys.